Okay, my friend Oyinda Amala, on a scale of 1 to 10, how prepared are you for the exams?
Honestly, I'm on 2%, sir.
2?
Yes, sir.
Ah, okay. All right. Well, the essence of why I'm actually asking is don't get discouraged and don't feel threatened in any way. FR is one of the courses that you should have a very restful mind to go to the exam or be confident that you are going there, you are writing, and you are coming back and you are passing the exams. Why am I saying it? It is more or less like an exam that you just go there, use your what you have known, the format, whatever it is that we have taught you, just go there, use it, and I believe you won't fail. And that is one area uh, in the skill level. I mean, in terms of financial reporting, one area that I believe that students shouldn't be finding difficult. If you have been attending the classes and listening to the videos that we have uploaded, at least some level of confidence should have been built in you. And that, not to worry, you still have almost a month plus to prepare for these exams. And I tell you the truth, if you choose to write it this diet, you can still prepare with this 1 month and write those exams. And for any of us that might have missed lecture so far, you don't understand it is better also for you to also, I mean, key into our intensive classes that is coming up. We'll be breaking it down a little further. Basically, we'll be looking at questions and tell you how to handle so many of the questions in your exam. So, for those of you that feel you have not prepared enough, please join the intensive class. I'm sure it will help us to be able to prepare well. Huh? So please don't get scared. FR is very, very simple. As far as I'm concerned, I believe it's one of the simplest course so far that you can write and pass. So simple it is. And all that you need to know is in your conceptual framework, some of the standards, as well as your publish account, and then the group and the ratio. And then we have not done group, we have not done ratio. I will have loved that if we are going to have lectures today, we should have even done group account or ratio today. But we need to actually focus on the publish account because a lot of persons have also told me that they don't know how to deal with the publish account. That being said, before we go into this question, I would like to go back again from the scratch in on publish account. Publish account simply means an account for a single entity, an account for a single entity. In other words, it is different from the group account. The group account is talking about you preparing a financial statement for two or more groups. That is, you are consolidating an account of two or more company together. Whereas the single entity account is an account that you are preparing for a company, a standalone company, as it were. Take for instance, now you have Dangote Nigeria Limited. Dangote Nigeria Limited, it's a sole company. And then if you have what we call Dangote Group comprised of two or more company. So the account you are going to prepare for Dangote Nigeria Limited is different from the account that you are going to prepare for Dangote Group. Dangote Nigeria Limited account is known as a single entity account, whereas Dangote Group account is known as a group account. And under the group account, we do what we call consolidation. But for a single entity account, we do what we call a single preparation and presentation of the financial statements. And remember that when we do conceptual framework, we discuss much in the chapters under the conceptual framework. There is a part, I think chapter 4 also, where we discuss about the component of financial statement. And we said that we have 5 major components of financial statement. The first one is the statement of financial position that tells us exactly what is the position of the asset or the resources of an entity. So it tells us whatever exactly is the balance of the asset as well as the balance of the portfolio, that is the capital employed in the business. So that is one, that's why they call it financial position. So it's stated the way it is. And we said, and I remember telling you that This financial statement is also known as the balance sheet. In other words, a sheet that must be balanced. That is, your asset must be equal to your equity plus liability, and that equity plus liability is what we know as a capital employed. So, in other words, your asset must be equal to the capital that is employed into the business. That's why we call it a balance sheet. So, your asset must be equal to your equity or your borrowings, and that is the first one to this. And then the second component of financial statement is the statement of profit or loss. And the statement of profit or loss deals with what exactly occur with your operations in the business, your core activities, your trading, as it were. What did you do in your trading? And this is where you look at the profit or the loss that you made at the end of a financial period. And then I told you clearly that the profit or loss statement is also known as a statement of comprehensive income. In other words, statement of profit or loss and other comprehensive income. In other words, we have the comprehensive income to be your profit or loss, as well as other ones which can come from your revaluation surplus, as well as gain on foreign exchange transactions. Wherever you have this foreign exchange transaction, there will usually be gain. You also recognize it in that other comprehensive income. Why do we put those ones under the other comprehensive income? Very simple. It is because they are more or less like what is not from your trading activity in the current year. In other words, they may not be cash, as it were, that you can, or income, as it were, into your business. So since it is not an income into your business in the current year, the simple meaning is you should only let us know what exactly it is. You are going to report it for users to be able to see it, because it does not translate into your current trading, as it were. And then we have what we call another component, the statement of cash flow. Your statement of cash flow is telling us about the cash that comes into the business and the cash that went out of the business. And then I told you that when we look at it the last time, I told you that cash flow has three major categories. The first category is the operating category. Operating category is the first one. And then the second category is the investing category. And the third category is the financing category. Operating category is simply talking about the operational activity in the business of an entity within a financial year. And this is where we look at the turnovers that you made. And then we are much concerned. Cash flow system is more concerned about the cash that flows in and out of the business within a financial year through your core activity, that is your trading for the year. So you are more concerned about what exactly transpire in your trading activity for the current year, and that is the operating segment of the cash flow. And then the investing, and then before I move to the investing, most of the items that you will use for exam purpose now, most of the items that you are going to use in the operating segment are usually in the profit or loss statement and the current the current asset and the current liability of the statement of financial position. Please take note of that. Most of the items that you use to determine the operating activity of a cash flow statement are usually in the profit or loss account and under the current or current asset and current liability in the statement of financial position. Take note of that. Whereas we have what we call the investing activity. And this investing activity is talking about the movement in terms of investment. And usually you either in a financial year, you either invest in another business or you invest in assets. So usually you look at the movement in terms of asset. You understand me now? And one thing that is important for you to note is they may not necessarily tell you that there were acquisition during the year. For example, now, they may not necessarily tell you that they acquire asset during the year or they sold asset during the year. But how will you know if there were purchases of asset, this investment in asset, or if there were disposals in asset? Very, very simple. Just compare the opening balance
Can anyone hear him?
if you have, for instance, now the opening balance of financial assets to be 200, and then the closing is now what is it called now? Let's say 300. It means that the opening is 200, but what you are closing with now is 300. It simply will mean that your opening is bigger than your closings. And also, class, true or false? Are we still together?
True, sir.
Okay.
Yes, sir.
Yes. Now, with that, you should be able to know that there is an acquisition or there is a disposal. So that is where you will now use your initiative and your wisdom to think. If I start now this year, I start my business this year with 200, and I'm closing the year with 300. It means that definitely there will have been an addition. Is that also? There will have been what we call an acquisition. Is that also? Are we still together? Answer me now.
Yes, sir.
Yes, sir.
Yes, sir. We are with you.
There will have been an acquisition because I open with 200. I'm closing now with 300. Meaning that there will have been what we call an acquisition during the year. And when you acquire, when you are buying, when you are acquiring, money is going out. And that's why we call it what we call a cash flow. So in that light now, you recognize that one as a cash outflow item. And how do you do it? Under the investment activity, you just say acquisition of asset, and then you recognize it there because you are going to deduct it. You are going to deduct it as it were. Then you have, let's assume that the beginning of the year, you started with 200 and you are now closing with 150. Imagine you started a business with 200 and then you are closing with 150. It means that there has been what we call disposal. Is that also disposal? In other words, we will have sold some of the asset because the asset has reduced as it were in value and in quantity. And so therefore, that disposal, the money will be coming to you. You recognize it as a cash inflow. You had it. It's as simple as that. Huh? And then you can have what we call investment in a subsidiary, joint ventures, associates, and the like. So once you have investment in all those subsidiaries, like you invest in all those subsidiaries, you should know that money is going out of you. If you receive from those investment that you have, that's interest income. If you receive it, you recognize it as an inflow. It's as simple as that. The same thing with your financing category. Under the financing activity, all that you need to recognize there are the movements in the capital employed. There are two components of capital employed. We have the owner's equity, that is the contribution of the owners, and we have what we call borrowings. You understand now? The owner's contribution are always in form of shares. Equity is in form of share. So wherever you see proceeds from share issue, you should know that that is what an additional income into the business. And what do? You recognize as a cash inflow. You had it. You understand? if the entity should go out to go and borrow money, that's an additional income to the entity. You also had it. And then if the company repay loan, do you understand? If the company or the entity repay loan back, you recognize that as a cash outflow. Also, for exam purposes, please note that it is also possible that they will not tell you that they actually borrowed money or there is a loan repayment. You can easily identify your loan repayment or borrowings by comparing the opening balances with their closing balances. And with that, you can easily note whether there is whether there is a cash outflow or a cash inflow, and then you recognize it. So, and then also under the financing activity, you look at dividend payment. If dividend was paid, you have to also recognize it under the financing activity. That is, if dividend were paid to the shareholder, you have to recognize it. Please take note of all of this that I've explained. It's very, very simple. And then you have statement of changes in equity. That's another component of financial statement. Statement of changes in equity. Statement of changes in equity is only comparing the opening balances of equity with what transpired during the year, and then giving us an overview for the end of the year. In other words, changes in equity, just as the name sounds, equity, meaning that all that you are valuing, all that you are looking at is equity. Whatever is under the equity is what you are considering. And under your equity, you have what we call the ordinary share, we have what we call the premium, the premium capital, we have what we call general reserve, retained earnings, all the composition, whatever item that is under the equity structure, that is what you are looking at. So they call it changes in equity. In other words, if, for instance, this is the current year, the current year we have now is 2025. Now the opening equity for this year will be what we close with in the year 2024. So what is it exactly that are the items that are under equity under 2024? That will form your basis. You understand me now? That will form the opening items that you will consider. And with that, you check what exactly has happened during the year 2025. Were there additional shares that were issued? Were there revaluation surplus? Were there additional profit that were made? Like that, and then you put them under their headings. And that's how to do changes in equity. And these four components are the main calculation. The last one, which is the fifth component, note to account, basically talks about the notes that you are going to explain certain assumptions, certain calculations, certain things that you have done. So it's as simple as that. That's everything about whether it's a single entity or group entity under published account. So understand that when we say published account, it has two legs. One leg is for the single entity, the other one is for the group. Do you understand it now? So published account is very, very simple. And why am I saying it's simple? And for example purpose, all that you need to know is to note how to just put down certain thing. You know, understand me now? The format. Know the format. Once you know the format and what is expected of you, all that you need to do is to begin fixing in the figures into those formats. And for your statement of financial position, I remember very clearly the last time that we discussed this, we talked about the format of putting down the statement of financial position. And the format is assets. And under the asset, you have what we call the non-current asset, and you have what we call the current asset. Simple. Under the non-current asset, you have your PPE. In other words, they may give you some items of PPE. PPE simply means property, plant, and equipment. We treated this under IAS 16, property, plant, and equipment. That instead of putting all those items on, motor vehicle, furniture, fittings, and putting all of them in your statement of financial position under asset, just go and put them under the PPE schedule and bring the total from the PPE schedule to your statement of financial position under PPE. As simple as that. You understand? And after PPE, you have the other non-current assets, like your intangible assets, We deal with that under IAS 38. Then you have what we call investment property, IAS 40. We also dealt with that in the course of our meeting over the time. And then you have, if we were to be grouped now, you bring in the goodwill from acquisition of a subsidiary, you bring it in under there. Then we also look at deferred tax under IAS. We discussed that. Deferred tax asset, you also bring it, and that is all that you need to note that is coming under your asset and your non-current asset under the asset of a financial position. And then we have the current asset. I'm just giving this overview for those of us that are still scared. This thing is very, very simple. Just know the format and know what we go to where. And once you note it, once you see it in an exam, don't overdo. Don't do as if you know everything. Do it according to your knowledge. We know that you are under exam tension, and 3 hours is not an enough time to test whether you know this thing 100%. I keep telling students, it is not 3 hours is not a guarantee that you know this thing 100%. So that's why we say attempt. We don't say answer the question. We say attempt. Or have you ever seen answer the question in any of your exam? No, they will say attempt as an accountant, because we know if you have the time, there is no way your account will not balance. And if account will not balance, you create a suspense account and put the difference in that place. Not be me tell you that one, no, because it is not practicable. So under the current asset, we have other items under the current asset, like your receivables, inventories, prepayments. And then if you also have deferred assets that you are to recover in the current year, you also bring it in under that place. And then after that one, you go to your equity and liability. And then I've explained what your equity are, and then liabilities are I think the network just tripped off now. Apologies for that. So, but I'm sure you heard me before we tripped off, right? Okay. So that is that for that. So let's quickly use this example to also try to, train ourselves more. And I believe with this, we should be okay and good to go. So we have this question that we are going to look at today. Akamata Nigeria Limited is a manufacturing company. Its finished products are stored in a nearby warehouse. That's the story and the story and the story. All that you need here to look at the overview and then move forward. The trial balance, you don't have time in your exam. That's why I'm saying this. Please just go to the trial balance. First of all, once you see a question in your exam, let me be telling you what to do. Once you see a question in your exam, the first thing that you have to do is to go and look at the requirement. What did they ask you to do? Go and check the requirement. And once you're able to check the requirement, it will guide you to know the information that you are looking at. So now they have given us this question. Let's go and look at the requirement first. What did they ask us to do? It said required. Sorry, please. Required. You are required to prepare what? Statement of profit or loss, another comprehensive income, as well as statement of changes in equity for the year ended at the 1st March 2020 23, mark 15 marks, and then the B part is a preparation of financial position as at March 31st, 2023. So you start first with the statement of profit or loss as you have been asked, and then you know that in your, so the first thing first is once you see this, just come to your solution and write down whatever it is that you need to do. Solution. I told us the last time, the first thing first is your heading. Akamata statement of profit or loss for the year ending, for the year ended 31st December 2023. That's that. Then you go to the next line, put your items. Then you put note, very important, you put note, so they will know you are professional. And then you put your Naira sign, and then the rounding off figure. Is the rounding off figure in this question in zeros or millions? Is in zero. So we put it there, it's in zeros. Now, I told us the last time, by doing this one alone, I can bet it with you, you already have about half or 1 mark by putting this heading as it were. You already have what we call one or half marks. And then you now know that statement of profit or loss, the first thing that will come is your revenue. Then you put it there, revenue. And then you go and check, where do I bring in revenue from? It will be in the trial balance. Check it. Usually your revenue is in the trial balance. 624,500. That is it. 624,500. Then once you see like this, you go to the additional information and check, are there anything related to revenue from the additional information, so you won't waste your time. Additional information 1, the property, plant, and equipment have been depreciated. And then they say depreciation of buildings considered an administrative cost. So all of this one does not concern you. You check the second additional information, it does not concern revenue. Income tax, it does not concern revenue. There, the fourth one is the closing inventory. The goods, they could then be sold. The wrongly packed goods were included in the closing inventory at their cost. It does not concern revenue. 7% loan, it does not concern revenue. The restructuring cost in the trial balance represent the cost of major. It does not concern revenue. So, since you have seen that all of the additional information, none of them concern revenue, you carry your revenue and go and put it there. Please, what is our revenue? Are we
624,500.
6 or 5?
624.
500.
Okay, thank you. So you put it there and then you go. Sorry, please. $624,500. I know that the next thing that will come here is your cost of sale. And also cost of sale. That's the next thing that will come. Cost of sale. So you go and check. Do I have cost of sale in this question? Did they give me my cost of sale? Always remember that your opening, what is it called? Opening inventory plus purchases minus your closing inventory will give you your cost of sale. Sometimes they may not give you cost of sale direct. They may give you all the items required for you to calculate your cost of sales. And we believe that if you are in skill level now, you already know how to prepare cost of sale because you have passed FA at the foundation level. So, but as a refresher, your cost of sale is your opening inventory, that is opening stock, plus purchases minus closing inventory. Now, we have, let's now from this place now, they told us that we have what we call cost of goods manufactured. Please, these are ways to also confuse students. cost of goods manufacture is different from cost of sale. Please take note of that. Cost of goods manufacture is different from cost of sale. Are we still together? Please take note of that. Because this is one way for them to also confuse you, because they can't confuse me again. So now it means that we have to do what we call workings. So we begin workings 1. Determination of cost of sale. Now, to also help you to be fast in your exam, once you have seen that and you have checked through, and you know that cost of sale, it will waste time for you to be able to determine it, as it were. You know that the next one will be gross profit. Is that also? You know that the next one will be gross profit. So since it is gross profit, you can just put it there as so that it will not waste your time. Gross profit. And then you know that after this gross profit, you are going to have other income. Is that also? Other income. You can put it. And then from other income, you have admin expense. And then you have distribution expense. And then you can put your finance cost. Nobody is penalizing you. Finance cost. And all of this you put it. So the reason why you are putting, as you are putting all of this, even if you forget to put figure, the examiner will feel that, okay, time was not enough. I mean, the marker will feel that, okay, time was not enough. That's why you couldn't fix those figures. Do you understand it now? These are gimmicks. These are logics. These are things to do to pass this exam. Do you get it now? Are we still together?
Yes, sir.
All right. So let's determine the cost of sale. So I told you it's opening inventory plus purchases minus closing inventory that give you your cost of goods sold. So now let's start with the one we know first. In this question, are we giving opening inventory? Do we have opening inventory in this question?
Yes.
Okay. What is our opening inventory?
24,060.
Okay, somebody will ask me now, where did we see that? Let me explain it to you. Any inventory that you see in the trial balance are always opening inventory, whereas the one that you see in additional information are always the closing inventory. That's 1. 2, in the trial balance, we were told that the inventory is at 31st of March 2022. But the books that we are looking at is for 31st of March 2023. 31st of March 2023. In other words, we have made mistake by putting 31st of December even in our book. These are also means by which these people will make you to fail this exam. They will not catch you. So we have 24,260. So let's go. We are determining our cost of sale. Remember, we are under workings. So our opening inventory is 24 what again?
24,260.
260, right?
Yes, sir.
Thank you. So now let's go and check if there are purchases in this question. If there are no purchases, we look at the cost of good manufacture, excluding depreciation. So we have cost of good manufacture, excluding depreciation. We had it to this. We had it. Sorry. Yes, we had it to this. Opening inventory, cost of good manufactured. How much is that?
170,000.
So that's that for that. So let's now go again. Let's check the trial balance. If we have any other thing that has to do with the cost of goods sold. Okay. And there are nothing there. So property, plant, and equipment are being depreciated as follows: building 5% per annum on straight line basis, plant and equipment 5% per annum on reducible basis. Depreciation of building is considered as administrative cost, while depreciation on plant and equipment should be treated as cost of sales. So we have to go and determine the depreciations. Are we still together?
Yes.
Thank you. So workings 2, determination of depreciation. So the first one is a building. Is that also?
Yes.
Okay. So now let's go and check. You want to say something? Please mute your mic. So let's go. What is our building? Revenue, administrative, restructuring, cost, interest received, loan, land and building, including land. Okay, 100,000, 251,500. Okay, so this is the current amount for 251. Are we still together? Please, can you still hear me, please? Okay, thank you. So we're told from the question that the building, inclusive in the building, is 100,000. Let's go back there and go and check so that it won't be as if. Look at the building. Is it land and building, including land of 100,000, is 251,500. Is that also 251,500? 251,500. And we now have what we call accumulated depreciation. Building 30,300, plant and equipment 8,350. But we have land and building, meaning at cost is 251,500. Please take note of that. At cost 251,500. So we have to remove the portion of land and then get the portion of the building. Are we still together? So what is the land and building? We were told is 251,500. So the land and building, the one for building will now be 251,500 minus 100,000. So this will be what? Our building. And that's 151,500. Please, I'm coming. 151,500. Okay. Are we okay with that? Do we understand it now? Okay. Let's deal with the one. Let's deal with the one that is well. We have started this one, so let's just conclude. Building 251. That's this one. Now, what did they say? They said building is on reducing balance basis. Where is it? Where is it? The building is considered. Okay, the plant and equipment are to be developed. Building per annum is straight line basis. Okay, straight line basis. Straight line basis. The property plan and agreement are being divided as follows. Building 5% per annum on a straight line basis. So our depreciation now will be 5% multiplied by 151,500. So depreciation will now be equals to 5% multiplied by 151,500. Please give me figure. What do we have? Are we still together?
7,575.
7,575. 7,575. So this 7,575, they said we should take it to where? Administrative expenses. So we are done with that. Then the other one is for plant and equipment. So let's go back and check what is in the plant and equipment. So the plant and equipment, the cost is what? 18,600. 18,600. Is that not so? Then we were told that we should be, where is that? Additional information. Plant and equipment should be divided 25% per annum on a reducing balance basis. Please take note. I'm sure I taught us under PPE section when we did IS 16 that there are two methods of depreciation, mainly two methods. We have the straight line and then the reducing balance method. Is that also? So now this is being tested. That's what I told you. I said they can test 50 standard in one question. Now they have tested PPE here. They are testing the depreciation method, whether you know how to do it. Now, for building, they say a straight line. For plant and equipment, it's on a reducing balance basis. So what is the cost for that of plant and equipment? What's the cost? Please give me a figure. Cost is what?
18,600.
18,600. What is the accumulated depreciation?
Is this question in our material?
Huh?
Is this question inside our material?
Yes, it's there.
Okay.
That's why I don't like giving material before class. You won't concentrate now. You go and check material. Eh?
No, sir. No, sir.
So what's the accumulated depreciation?
8,050.
8,000.
350.
350. So when you less this 8,350 to give you your current amount, so what's 8,350 minus this will give us what?
10,250.
So current amount is 10,250. But we're now told, so the current year depreciation will now be equal to 10,250 multiplied by 25%. Is that not what they told us? On reducing balance basis. So what do we have?
2563.
Are there any other figure after that one? 25.
No, it has approximated.
Okay.
We have 2,562.5.
Okay, 2563. Thank you.
Yes, sir.
So they said the one for plant and equipment should be taken to where? Should be taken to cost of sales. So you have depreciation, plant and equipment. 2005. 5 what? 523, right?
63.
2063. So that is that for that. So any other thing that is let's check what other things do we have again that is going to come to. Let's check all the additional information. I think we are done with 1. 2 is not coming there. Income tax is not. Let's say closing inventory. Assuming there were no all this other explanation now, we'll have just carried 25,900 and deduct it from what we have gotten, and that will give us our cost of sales. But we can see here, we were told that the closing inventory as at the 1st of March is 25,900. An inspection of the finished goods shows that a production machine has been set up incorrectly, and that several production batches which had cost 250,000 to manufacture had wrong packaging. The goods cannot be sold in this condition, but could be repacked at an additional cost of 100,000. They could then be sold for 275,000. The wrong packed goods were included in the closing inventory at their cost of 250,000. And then the last class, I remember that we dealt with it with this one explicitly. We talked about it so very much. What is expected here is for us to determine an amount that will be written down, that is, an amount that will be removed from the closing inventory. Because why? Because they said that there is part of this closing inventory that had what we call a defect. You understand? And said the cost of the defect is 250,000 naira. But then they said the goods cannot be sold in this condition, but then we can repack it for 100,000. That is the cost of the packaging. This item of 250,000 is 100,000, and then they could now be sold for 275,000. Now look at it this way: there is a defect, and the cost of that defect inventory is 250. But for us to correct it, we are going to spend 100,000. So if you remove 100,000 from 250,000, it means you are going to have 150,000. Is that not so? When you now remove, then I said the goods cannot be sold for 275,000. So when you remove 275,000 from 150, what will be remaining? 75,000. I want to believe so. Are we still together? So that 75,000 is what we will now deduct from what is it called? From the closing inventory to give us an exact amount that we are going to carry forward. Is that clear enough? Are we still together? I'm sure it is clear.
Can you explain that again, sir?
Sorry, I can't hear him again. No, I hope it's not my network.
It's general.
Okay.
Hello, please. This question that we are solving, please, do we have the question already? If you have, please, can someone forward it to the group, please?
He said the question is in the material. If you have the material, which means you should have the question.
But he said
Please,
that
which material? Which material?
that's
Because
not.
I just checked now. I'm trying to check everything. I don't know. Like which topic?
Check the chat box. You see the past question. Check it.
Okay, it is past question. Okay. Do you know the diet, please? So I can just check it.
November 2023.
November 2023. Thank you.
I hope that we are still waiting for him.
I don't know if you can. Yeah, I can't hear anything.
Hello, is anyone there?
You are still waiting for him. Oh, we are there. There we are.
Please, is the class stay on? I can't hear anything.
Back. He said he's going to talk to you.
He dropped a message in the group chat.
All right, sincere apologies. Please, can you hear me now?
No, sir.
Yes, sir. Welcome.
The network has just been something else. Sorry, please. So, okay, so we're looking determination of what's closing inventory. Okay, so what was the balance, bro? I'm sure you see how that question. Let's quickly run through it because I will look at today. Very, very important. What was the balance brought forward? As per trial balance. Closing inventory as per trial balance is how much?
There's no closing inventory in trial balance. It's on the additional information.
Yes, please give me what do we have there? How much is it?
5,900.
The closing inventory.
5,900. Yes.
The one in the additional information, please.
Yes, 25,900.
25,900. Okay, so now we were now told that part of this 25,900, we have the one that that is defected, and there's 250,000. Is that also? So we were now told that to work on this one that is defected, we are going to spend additional 100. And if we are going to spend that additional 100, it means we are going to sell it for 250,000, 250 rather. In other words, it implies that we have to determine the amount that we're going to write down, because if we check the net realizable value, because according to IS2, we are going to choose the lower of net realizable value and cost. Is that also? We are going to choose the lesser of the two. And if there are any differences, we are going to write it off. So now, the cost now is how much? 250. Is that also? The cost.
Yes, sir.
The cost is 250. But they now said that this 250,000, which is the cost, if we are going to repackage it, if we are going to work on it, we are going to spend additional 100. Is that also? Is that also? Do we agree? But
Yes, sir.
but we were now told that we can now sell it for 275 after spending that amount. Therefore, our net realizable value will now be equal to 275 minus 100. And that will be equal to what? 175. Is that also?
Yes, sir.
Meaning there will be a written up value of how much here? There will be a written down value. That is a loss. Written down value now. That is loss, which you must take from the closing inventory now. Will now be equal to 250 minus 250 minus 175. How much is that? Hello.
75.
Hello. 75. Thank you. So now this is 75 is like a loss. Now let's put this thing in perspective appropriately. So we have interest. Net realizable value is 175, but the costs is 250. And according to our IS2, our recoverable value will be the lower of the net realizable value and cost. So we are going to choose the lower. But if we are going to choose the lower as what we are going to recognize, it means that there is a loss. And where would that loss go to? The loss will go to the profit or loss account. So the loss is 75. That's why we call it written down value. Is that taken? I hope we have been able to study our IS2 inventory very well. Please, if you have not studied it, it's very important that we go back to it. At this level, I should not be teaching you inventory. You should know it. It's what we do in a foundation class, inventory. Very simple. So this 75 now, that's what we call the written down value. So this written down value of 75 will now be taken away from our closing inventory brought forward. That is 75. Because it is what? A written down value. That is a loss. A loss. Let me explain this. Let me explain this thing again, because I'm sure so many of us do not even understand what I've just explained. Now, from the additional information, let's go back to that inventory. We were told that the closing inventory as at March 31st, 2023 was 25,900. But upon inspection of the finished good, it was discovered that a production machine had been set up incorrectly, and these had given several production batches which had a cost of 250 to manufacture had wrong packaging. Now understand this, that it is not the product that is defected, it is the packaging that is having an issue here. Nothing is wrong with the product as it were, but the packaging is what that is off. And we were told that the cost, because it's also part of the direct cost of this stock, is 250,000. So we have been able to isolate cost. But we're now told that the goods cannot be sold in that condition because it has a wrong packaging input. In other words, the packaging is wrong. It is defected. You understand me now? But for us to correct this now, we are going to now spend additional of 100,000 unbudgeted 100,000. Then if we are able to now correct it now, then this product can now be sold for 275,000. Are we together? Since it is not, since we can sell it for 275,000, that is the amount that can be realized if we are going to sell it. Now, assuming that there were no additional costs, you understand? There were no additional costs to correct this defect. What we'll have just done is to compare the cost and the net realizable value and choose the lowest as what we recognize in our, what is it called? In our closing inventory. Do you understand it now? But since there is a cost, what we just do is to remove the cost from the amount that we can realize, which is 275 is all we can realize, and the cost is 100. And then we now have 175 as the net realizable value. But if we compare the cost, which is 250, and to 175, we know that the lowest in between these two is 175. You understand me now? So once the net realizable value is lower than cost under inventory, there will always be what we call a written down value, that is a loss, as it were, that you must take away from depreciation. It is just like when you have impairment, for instance, under IS 30, is it 36 now? Impairment. Once you have impairment, you take it from the profit. It's the same thing here. there is a loss. You understand me? And that loss must be borne by the profit. That is what we have done here. Is it clearer now? Indamola? Are we still together? Can you hear me?
Yes, I can hear you, sir.
Is it clear now?
Yes, sir. Very clear, sir. Thank you, sir.
Onuche Victor,
Yes, sir.
it's clear, right?
Very clear, sir.
Thank you so much. So let's proceed. So we have been able to identify. So our closing inventory will now be what now? This 75 minus closing inventory. This, what is it now? Let me know. That's
25,825 naira.
25,000.
825.
825. Thank you. So that is our closing inventory. So we are going to take it to, where is it? Cost of sale. Where are we? Determination of cost of sale. And remember, we say opening plus all of these. So we are going to now less closing inventory from it to get our. So let me put it here. Less closing inventory. That's 28 what, please? 28,000. 28,000 what, please? Are we 25,000?
25,825.
25,825.
So let's less it. What do we have as our cost of sales? Cost of sales what, please? 470. 998.
8.
Thank you so much. So we'll take it there to our. You see, this is the reason why I said don't go and start with question 1. If not, you are coming back to write your exam. 470,998. Look at the time that we have spent to do only profit or loss. So we have not done any other thing. So our gross profit is what now? Are we still together? 153,000. what, please?
502.
502. So that's that for that. Yeah. So let's go. What do we have again? Other income. Other income. So let's check. What do we have as other income here? Okay, let's go. We go and check other income. Interest received 6,000. Right? 6,000 is other income, right? We agree. This interest received, is it part of our other income?
Yes, sir.
Okay.
Yes, sir.
Affirmative.
Thank you. Is there any other income again? Let's check the additional information. Okay. So our other income will be 6,000. Other income, that is interest received. Interest received 6,000. So let's go. Admin expense. What do we have as our admin expense? Our admin expense will not be. Please, what do we have there? I know there was one depreciation I said we should take there. That one 7 what? What do we have in the question as admin expense?
7,575.
7,575. But before this 7,575, we have one this thing.
Yes, there's an admin expense in there.
What is the admin expense, please?
80,100.
80.
100.
So what's the total? Is there any other? I think that's the only two things. So what do we have? Oh, yeah.
87,675.
87,675.
675.
Thank you. Then distribution expense. Is there anything to distribution expense? Is there any working? So distribution expense? I don't think so.
No.
45,300. Now, this our restructuring cost. We can as well bring it. Well, I saw restructuring cost now. Plus, how much is the restructuring cost?
It's so
605.
605. So we can bring it into administrative cost. Now, let me explain distribution cost. Why you can't bring it there? Distribution cost has to do with everything that has to do with trading, that is selling of your product. Distribution cost has to do with every cost that has to do with selling of the product. So what will now be our figure now? 80 what?
88280.
88280. Then our distribution expense, what do we have there?
45300.
45300.
300.
Okay. Our finance costs, let me just tell you the secret. No matter what they are saying, except if the question said take for 6 months. But if the question did not say take for 6 months, just go and do direct there. Just do direct for 1 year. Finance cost is always per year. Let's go back to the question. We're told that the 7% loan notes are for 10 years. and they always due for repayment. Is due for repayment at the 1st of March 2027. Interest of this loan notes needs to be accrued for 6 months to March 31st, 2023. But we have, I think I saw something like finance costs in the trial balance. Yes. Loan note interest paid 3195. And we are now told in the additional information that we should also accrue additional 6 months. In other words, instead of doing too much of voila, we were told that where is the loan? 7% loan note, 91,250. Just go direct and do it directly inside your paper. Yes, you don't have time. So you have 7% multiplied by, what's that loan note again? How much is that? Are we together?
91 to 50.
91,250, right?
250.
Yes. So what do we have? Oh, yeah. What do we have, please? Eh? You said?
6387.5.
63. And we are approximating now.
888.
8. Ah, all right. Okay. Yeah. The next thing will be profit before tax. So what is the profit before tax? Well, profit before tax, and you have tax for the year.
In profit before tax is 19,534.
19,534. Okay. Thank you, sir. 19,534. So what is our tax? Our tax for the year is what? Like I told us in the last class, your tax for the year is usually in additional information. It is always be given to you in additional information. Always ignore the one that is in the trial balance, except where you need to determine, the beginning and what you are going to add to the tax for the year, that is the deductible or the payable deferred tax. What I'm saying is this: always your tax for the year will always be in the additional information. But sometimes when you have deferred tax in the trial balance, that deferred tax in the trial balance will be the opening deferred tax, and then there will always be deferred tax also in additional information. That deferred tax in additional information is the closing deferred tax. So check the two together. Now, assuming that we have deferred tax at the beginning of the year to be 100, and at the closing is now what is it called? 150. Once you see it that way, it means that there is an additional deferred tax. Is that not so? Meaning that there is additional amount that you are going to pay. Do you get what I just explained now? Or let me come again. Let's assume that in trial balance we have 100 as deferred tax in the trial balance. 100. You are now closing with 150 at the end of the year. The simple meaning is that the one you are owing, you have not paid. You are now incurring additional deferred tax to it. That additional 50, you will add it to the current year tax. That's what we call the payable deferred tax. That is, you are owing the tax authority, so you will add it as part of your liability. But assuming that we open with 100, we are now closing with 50. It means that there is a payment of 50. That 50 payment, you are going to remove it from the current year tax. We have done this thing in IS 12. Just go over it again, you understand it. Just a refresher as it were. So our tax for the year we're given, what did they give us in the additional information?
4880.
So that's our tax for the year, 4880. So
Okay.
once
Sorry,
you
sir.
have to less this one. Go ahead.
So please, I would just want to get a clarification regarding to this diva tax you just made mention now. Supposing the one we are having in the additional information is lesser than what you are having in the TB, shows that we've already paid. Then the tax for the year now, that means that we are going to deduct it from the tax for the year.
Yes, you are going to do that difference. That difference. That's what we call temporary
Yes, that's
difference.
what
The deductible temporary difference. So you remove it from your current year tax.
Okay, thank you, sir.
All right, no problem. So our profit for the year is now how much? This
14,654.
654.
14.
654.
654.
So and that does it for us. But you see, if you are very fast in the exam, or these are things that you can easily do, achieve, and move ahead. The only place you may be having issues are all these other adjustments that you have to just do. That's why I always say that once you are in the exam mode, please make sure that you first of all attempt 2 or 3 questions before you go to question 1. So that is that for that. Now, before we close this account, I saw something in the additional information too. We're told that the land and building, the land was revalued. Let's go back.
Yes,
By the time you
120,000.
are reading additional information, by the time you are reading additional information over and over again, the thing will stick to your head, so you will know where to use it, even if you have forgotten. They tell that the 1st of March 2023, the land was revalued to 120,000. And remember, from the trial balance, we were told that the land and the constituent in the land and building is 100,000. So there is what we call 20,000 additional. Is that also? Do we agree?
Yes.
So this 20,000 naira, will mean what? An OCI will be what we recognize as a revaluation gain on our land. Do we agree to that? Revaluation.
Yes. Come again.
Now, we're told at the end of the year, the land was revalued to 120,000. And in our trial balance, we were told that what is inclusive in the land and building is 100,000, meaning the cost as at that time is 100,000. And you don't depreciate land. Land remains the way it is. So, but we were told that the value of the land has now been, we have done our valuations and the likes, and land is now 120,000, meaning there is a revaluation gain of 20,000. Revaluation gain of 20,000, that is 100K minus 120K. And that will be the valuation gain of 20,000 naira. So instead of doing it as additional workings, I just did it here directly. It is also still allowed, but that's for your exam. But as a professional, if you are the one preparing for your client, you can't do it. You should not do it that. You should not do it that way, please. Please, I'm begging you now. Don't do it that way. Are we still together? Eh?
Yes, sir.
Hello, sorry, sir. Can you recap, sir? My network was faulty. Can you recap, sir?
I said, me now in your exams, you are allowed to do what I've just done here, putting revaluation gain here, and you saying 100K minus 120K, and you get your 20K. Do you understand? But as a professional, if you are preparing for your client, you go and do it as workings. You understand? To be part of your notes to account. That's what I've just explained. So it's as simple as that. So you now have total comprehensive income. Total comprehensive income. So will now be how much?
34,654.
34,654. 34,654. And with this, you know that you are done. You are done with your profit or loss account. So they say we should also prepare statement of changes in equity. Statement of changes in equity. Any question? Go ahead, please.
This revaluation gain, sir, can we put it under income?
It's other income. Okay, let me just include it. Other income. Is it okay like this?
OCI.
Revaluation gains, OCI, not other income.
Other comprehensive income. Other comprehensive income.
Or am I the only one that is not seeing his screen?
So because they are not part of your equity. So, okay, let me recap. Go straight to your, once you say statement of changes in equity, in fact, let me also say this now. As once you are asked to do this statement of profit or loss, just look at the formula that what I've just drafted now. Just write everything out there, from revenue to profit to other comprehensive income. Then go to statement of changes in equity. Put the headings down. Put everything that you need to put down there, and then with that, you can even do your statement of changes in equity before any other, because that one is always very easy. Now, are we still together, please? So you have under statement of changes in equity. The first thing first, you have the items. And what are the items? I told you, just go straight to the trial balance. Anything you see under the equity, you bring it here. So we have the share or ordinary share capital, ordinary share. I will use share capital. You can use ordinary share, the same thing. Then you have the share premium. Share premium is there. I think I saw something like retained earning also. Retained earnings. What other thing is under the equity portion?
Valuation surplus.
Okay, thank you so much. Revaluation surplus is also there. Any other thing, please? Then you
Now,
have time.
Reserves.
Huh?
Other reserves.
Yeah, you said?
Other reserves.
We have other reserve in that trial balance.
no, sir.
That's why I said just check what is under the trial balance. That's what you should just use directly. You understand? Then you have the first thing. First is opening balance, or you put balance at 1st April, since this accounting year is ending at March. So 1st April 2022 now. What's the share capital opening? Go straight now. 100,000. Okay. The share premium is what?
2,150.
2150. What is the retained earning?
143.85.
143.85. Yeah, the valuation surplus. Is there anything there?
15,625.
15,625. The total is what? Please get the total. Then the next thing that we do, the check is, are there shared our issues? Let's check the additional information we have, all right? Additional information. During the year, the company issue C, there's an additional issue of 10 million shares at the rate of 1 naira 20 kobo. So once there is a share issue, the first thing you should go and check is how much was it sold for. That's the first step. Then the second step, or the second thing that you check for, is how much is the ordinary share? How much is the worth of one ordinary share? Now, from this one, they say 10 million was issued at 1 naira 20 kobo. Now, let's go back to the trial balance. What exactly is our ordinary share? They say our ordinary share, the value of one ordinary share is 1 naira. Once you see that the share is being sold higher than the nominal value, then you should know that there will be what we call premium. Is that taken? It means that the share that was issued for that year, you're going to divide it into two. There will be share capital, there will be share premium, because they sold the share above the nominal value. They showed the share was sold above the original price. Is that taken? I know it is taken.
Yes, sir.
So let's go ahead and check it now. So there is what we call share issue.
Premium.
So since there is share issue, there's also share premium. Yes. So our share issue will now be, they said they issue 10,000. So it will now be 10,000. Let me just put 10K because there's no space. Multiply by 1 naira.
1 naira.
So this one will come under.
Million.
Just don't worry. Just 10,000, not. That's 10,000.
10,000. Yes, sir.
Yes.
Yes.
Then the share premium will now be 10,000, 10K multiplied by 2 kobo. 0.2. That's
okay. 0.2. Okay.
2 kobo. 0.0 naira 2 kobo. For the sake of those that don't know what we are doing now, let's do it this way. So that's 2,000. So this one is always very simple. Setting of changes in equity is the most simplest out of all this thing to always compute 2,000. Then the next thing will now be profit for the year. Profit for the year. How much is the profit for the year? That profit for the year will come under the retained earning.
Which is the total
Sorry,
income for
there's a
the year.
mistake here, and you did not correct me. This one is supposed to come under the share premium, the 2,000.
Share premium.
Okay, so how much is the profit for the year?
Retained earning.
34,654.
No, profit for the year, please.
2,654.
34,654. 34,654.
No,
No,
profit.
14,654.
Okay, sorry. 14,654. 14,654.
Then you now have the valuation gain, right?
Yes.
Valuation gain. That one will come under the valuation surplus, or sometimes you put it under what we call general reserve. So what's our valuation gain? That's 20,000. Do we have any dividend that was paid?
Yes.
Yes, we have.
The tribal.
We have ordinary
Okay.
dividend.
How much is it? Okay,
5,000.
dividend paid. Please. Once you hear dividend paid, always check if it's for ordinary shareholder. Very important. Dividend paid 5,000. If they are silent, if there is no any other information about that, if you want to just say dividend paid, and they are silent, did not give you any additional information on it, just take it as a dividend that is paid to the ordinary shareholder. Please take note. Then there is a difference between dividend paid and dividend declared to be paid. Once you hear dividend declared to be paid, please don't adjust for it. They have not paid for that financial year. What you do is to go and recognize it in the notes to the account. It will not be recognized on your statement or on your any of your financial any of your statements. Is that taken?
Okay, sir. Sir, what of if it is dividend paid to preference apart from the ordinary shareholders?
Please
How will it be treated?
Don't bring it under statement of changes in equity. Why? Because the one paid to preference shareholder is not, you see, changes in equity deals with only ordinary shareholder. What is accruing to the ordinary shareholder? Preference shareholder, they are ranking shares. You understand? When there are issues of winding up, or when you need to pay them, but they call it preference share because their share must, when there are obligations to settle, you have to settle them before the ordinary shareholder. Once you see any preference share, please ignore it in a statement of changes in equity. And you also ignore it in your statement of profit or loss. Is that taken? Where you will only account for them if there is any need to is in your statement of financial position, just to show the users that you have that composition, you have that component in your capital that you employed in the business. Do you understand it now?
Okay, sir. Thank you, sir.
All right. So please get all of these totals. What do we have under total for balance at that? So if there are no any other thing, all that you need to just put down is balance at balance at 31st of December, 31st March. So you have balance at 31st March 2023. So what do we have? This for share capital, we are going to have 110. You can see there. Compute the total. Let me see.
4,150.
4,150. For retained earning, we are going to have what?
150,039.
150.
039.
039. Then for the valuation surplus, we are going to have
35,625.
35,
625.
625. But please, the total here, that's what I need though. That total. Just total 110, 415, 135. And give me here. What do I have?
299,814. 299,814.
299.
814.
14. So what do we have? The total at the beginning. What do we have there?
258.
258.
160.
160. So now when you check the opening equity, you see 258, 160, but we are closing with 299,814. Is that also? Meaning that there has been changes in the equity structure. For instance, we have share issue, share premium. So the essence of this statement of changes in equity is to show the users what exactly transpired, from the beginning of the year to the end of the year with the equity structure. That is the capital that is employed in the business as it were. Do you understand it now? So we want to know what exactly happened with the owner's contribution into the business. You understand now? That's why we are doing what we call these changes in equity as it were.
Equity.
Is it clear enough? I'm sure it is clear.
Yes, sir.
Any question? So you can easily deal with it now in your exam when you see it. I'm very certain of that. So now let's go to the statement of financial position. This is
So we haven't added the other change in equity to the total.
Please add it now. You people that we had that one, there's no.
No, I'm just saying for other people that may not even understand.
Okay, please. It's very important that you add it to statement of financial position. So most people used to do this number one question as if they have answered two questions, they will now go to question one to check if they can do it. If you can do it, you are too sure that you are not going to come back for your FR. But I can assure you that no matter what they are bringing, it's just some little adjustment that may confuse you. And once those things confuse you, don't let them confuse you. Do the ones you know. Do the ones you know. Fix the one you know according to how it should be. And leave it. You don't need to balance. You understand now that this one the changes in equity that we are writing total. You don't have the time. If you cannot write, leave it. Just fix those figures there and move. Do you understand what I'm saying now?
Yes, sir.
Thank you. So let's go. Statement of changes in equity. I'm tired though. So you have the non-current assets. Then you have the non-current assets. We have to go and do okay, let's identify them the way they are. We are supposed to write PPE, yeah? But that means we are going to do another workings. And I don't think I have that strength now. Workings 5. PPE schedule. Okay. How about this thing? Yeah, that's good. PPE schedule. So you have items. You have so we have land. We have building. I'm doing this now to refresh some people's brain. If not, I won't do it again. And then we have plants. Are we still together?
Yes, sir.
Yes, sir.
And, equipment. Then you have total. So what's the cost?
Land
Oh yeah, as per trial
100,000.
balance. So it's 100,000. Building is
Building
what?
1,500.
151,500. The plant?
18,600.
15,600. Total. You're doing that one on your own. Are they additional during the
2,100.
2,100.
you said?
270,100.
27,100.
100.
Okay. Where are all the men now? Why is it that only my ladies they talk?
We are here. We are here. We don't
What
want
of the
to. We don't want the class to be rowdy, so that's why we keep quiet.
okay? Are there additionals during the year?
Yes,
No.
sir. Revaluation of 20,000
That's not
land
additional.
for land.
So that's what we now have is revaluation. Let's go ahead.
Sir, can you explain that additions on that pay schedule?
You said?
Can you explain that additions on that pay schedule? How can we identify it on the trial
Addition
balance?
is if they buy any asset during the year. If they buy any asset during the year, they will tell you that they buy asset.
Okay,
That
sir.
taking? Yeah, they will tell
Yes.
you. Thank you. So we have there is no additional. So we have revaluation for land. That's 20,000.
20,000. Yes, sir.
And that's that for that. So we can close this.
Hello, sir. Plant and equipment. Cost of plant and equipment is 18,600, not 15,600.
This one.
Thank you. Yes, sir.
So this one will be 270 something now. 73, right?
No, it's still 270,100 because I use 18,600.
Okay, thank you. So you have so you now have depreciation here. So for land, there will be none. You have accumulated depreciation.
And for the year.
Accum depreciation. Then dip for the year. So what is our accumulated depreciation for land?
Dash.
For building is how much? Oh yeah.
3,300. 3,300.
For plant and equipment.
8,350.
2,350.
8,350.
350.
Okay. Depreciation for the year. Building.
7,500 for building.
575.
Okay. Then for plant and equipment.
2,563.
2,963.
563.
563. Okay. So
Total.
come in. Total A. So what's total A now? This one is 120,000. This one is 151.
500.
This one is 18.
600.
600.
270.
No, this one will change now. That will now be 290. 100. So this is preposition B. So you have total B. Some will be nothing.
Dash 37,875. 37,875.
875. And this one will be 11 something. 10 what?
10,913.
10,913.
Okay. So carrying amount now will not be A minus B. Go ahead, please. And this one will be what?
120.
The total here is 48. You said 48 what, please? 8. Somebody should help me talk.
78.
Like this?
I think she's saying 48,768.
768.
768. I think she's saying 48,768.
768.
Your network is not clear.
Bros, your network clear. You talk now. 748 what?
788.
Hold on, sir.
48,788.
788.
Yeah, what's the difference between that one and this one?
113,625 for building.
The total.
241,312. 241,312. 312.
Please always see. Once you get the total, you may not need the total of everything. Once you get those total A, you understand me now? Just minus it. That you only need this last figure that we got is what we need to carry there. So how you got it? No, because there is no time. You understand? Yeah.
Thank you, sir.
So our BP is 241,312. So let's go. Hawkins 5. PPE. Two 4 312.
312.
Thank you.
Yes, sir.
That's Hawkins 5. So from now, is there any other item?
Investment property.
Investment property.
Yes, sir.
Okay. Investment property.
Yeah, right.
I better mute your mic, please. Investment property at market value 120. Is there anything they said about the investment property? I don't think so. They said no adjustment was made. So let's go ahead. Investment property, 120,000. Any other thing? So you have current assets. Under the current asset, the first thing first that you bring here is your inventory. We have already worked on that.
Inventory.
Inventory. Workings, what is that? Workings 3, I guess. Yes, workings 3. Okay. What do we have? We are now
25825.
25825.
25825. Then the next thing will be trade receivable. How much is it? We didn't do any adjustment to it, so just carry direct. Trade receivable. How much?
46,650.
46,650. So that's why I tell you that this thing is very simple. Sometimes just to carry and put, carry and put, carry and put. The next one is what? Cash and or is there any prepayment? I don't think so. Cash and prepayment, cash and cash equivalent. How much?
5,950.
5,950. Okay. Is there any other thing again?
No.
Total assets. Yeah, somebody should be checking that. Why we go to total assets? So we have equity and liability. Equity and liability.
Asset.
Total assets what?
239,737.
Total assets.
Yes, sir, it's correct.
439,737.
Okay. Now, under equity and liability, the first thing that you will carry is your equity. So under your equity now, since you have done your statement of changes in equity, just go and carry the totals. What you have there as the headline, the first, you bring them. I remember we have share capital, right? We have share capital.
Yes. Ordinary share capital.
We have share premium.
Retain any.
We have retained any.
Reserve.
And then we have revaluation, surplus, or reserve. Anyone or reserve, anyone. So the total there, that's what you will just bring here. Don't bother yourself. Yeah, give me a total. What are the total? Share capital, what do we have total?
110,000.
110,000.
4,150.
4,150. 4,150.
150. 039.
150. 039. Then revaluation reserve.
35,625.
35. Sorry, I'm coming. 625. Okay, that's all right.
Yes, sir.
That's that. So we'll go to go ahead. Because you were raising your hand. Go ahead, please.
I want to know how we got this 200,000 for next time.
Huh?
Not having one. I don't have 110,000 for equity. I want to know how we got it.
Check the
The
same
share
of changes
capital,
in
the
equity.
adjustment.
Okay, let's go
The
back there. See our
balance at the
statement of
bottom.
changes in equity. Look at the one we have here now. Balance at 31st of March. Look at it now. 110, 450,
After the
150,
adjustment.
35. Have you seen it? Chikodi.
Yes.
They have done the terms.
So
Hello,
let's go
sir.
to liability.
On that. Hello, sir.
Yes, go ahead.
Sir, as we are having the new change in equity now, do we need to make reference like working on so, or there's no need? Because we are having two, equities now. There is one given to us on the TB, while the one from the changing in equity. I mean, if we want to make a reference to the current one, and since the one we want to use now on our financial position, do we need to make reference just like what we just did now by saying work note something or no need?
There is no need because you have to prepare yourself and changes in equity before your center of financial position. That's why you prepare before you prepare the center of financial position. So there is no need. But for members of the public who are laymen, you can always refer them, coin it in a professional way that you are doing so and so, simple and move. But there is no time for you to be doing all of those things. But we know that that's where you got your figure from because it's directly going to be under your center of financial, under your center of changes in equity. You understand? Because if you are going to make reference, if you are going to make reference one after the other now, how do you now put it? Is it refer to center of changes in equity or what? Inside this, it will make your work off.
Exactly, sir. I'm just asking.
So now let's go to the non-current liability. We were told there's a loan note. How much? Is this 7% or 8% loan note?
7% loan note.
7%.
So how much is that?
91,250.
91,250. Is there any other non-current liability? Current liability were payables. How much is that?
4,600.
4,600. Any adjustment? I don't think so. You have which one again?
Current tax.
Current year tax. How much is that?
4,880.
4,880. Any other thing?
Interest paid. Accrued interest.
Okay. I wanted to explain that one. Thank God you even remind me now. I wanted to explain that one earlier. I said, okay, when we get to the financial vision, I was going to explain. There is an accrued interest in your additional information. And the essence of what they are telling you is so that you will know that the interest is allowed to be paid in 6 months. And the trial balance have already told us that they are paid the first 6 months. And then the additional information is telling us that we should accrue for another 6 months. So now let's accrue. Interest accrued. Thank you for bringing that up. Interest accrued. So that will now be 7% multiplied by 91,250 multiplied by 6/12. What will it give to us?
3,194.
3,194. Total. Oh, total. Okay. So what do we have? Equity and liability total how much?
439,738. 439,738. Difference of 1 was.
That will come from approximation. Total.
Rounding.
Rounding off, yes, rounding off error. For what?
439,738.
7. What do we have in the first one there? What is the total asset?
Total is 439,737.
737. You must always be balanced. So your accrued interest will be 473. You understand it?
Yes.
Yes, sir.
Well done, sir.
Thank you. So you can see that publish account, what's her name? My friend, Damilola. You can see that publish account is actually very simple. Chikodi, you can see it's very, very simple.
It's not okay.
So tell me now, where do you have issues now? This one we just did now. Which one?
Information.
Okay. Uduado, Eneabasi, Uduado. Sorry if I'm murdering your name. You raise your hand.
Yes, sir. I have a question.
No, first of all, tell me how to pronounce this your name. Udo. Okay.
Udo.
Neabasi, Udo. Okay, go ahead, please.
Yes. Sir, please. So during under our current tax for the year, so what if we had deferred tax for that was carried forward from last year? Are we going to adjust it in our statement of financial position?
That's why I said once you have deferred tax, the deferred tax will be in your trial balance as well as in your additional information. You understand me now? You have to do some adjustments with that. You have to check what is the opening and the closing. Now, if the closing is higher than the opening, you should know that there is an additional that you are going to pay. You add it to the current year. Now, carrying as your current year tax in your profit or loss is what you are going to recognize under your current liability. Now, why are you going to deduct deferred tax that is lower? It's because you have used it. Remember, I told you deferred tax are caused by what we call temporary difference. Temporary difference between the current amount of an asset and the tax base of an asset. And this can result to either deferred tax asset or deferred tax liability. Deferred tax asset now, it implies that you can recover it back from the tax people, the tax authority. That is, it is recoverable. That's what we call it, deductible and recoverable. Do you understand me now? So you can have what we call recoverable temporary difference and deductible temporary difference. So when you have what we call recoverable temporary difference, it means that it is an amount that you can recover from the tax that you are owing the government. So there are two things that can happen. Either you wait and get it from the government, which is not likable, or in your computation of your tax, that amount that you know that is, you know that you can recover, you deduct it from the current year tax. And then the one that is deductible is the one that you are still owing them. You have calculated and you have seen that you are owing them. You will add it to the current year tax. That's why the one that is higher, at the end, compared to the opening, you had it. The one that is lower, you less. And then to give you your current year tax that you have to pay. That current year tax that you have to pay, that you recognize your profit or loss, is what you will not take to your statement of financial position under your current liability as it were. Clear?
Yes, sir. Thank you very much.
So please take the screen to Workings 5 of PPE.
Workings 5 PPE. Okay. We are here. Are we still together?
Yes, sir. Yes, sir. Thank you, sir. I've seen it.
Thank you. All right. Any question? I think we have to call it a day. Or before we go, please, let me just quickly introduce us to. Don't go now. Where's Lazarus going to now? Don't run away.
Take the screen back to the segment of the workings.
Hawkins 1, determination of cost of sales.
Yes, sir, from them.
Hawkins 2, determination of depreciation. Hawkins 3, determination of closing inventories.
Oh, please, sir, can someone just send it on the group chat so I can.
What exactly is that?
The workings, the solution from the working and everything for today.
The
You know,
group chat.
before you add it to the YouTube link, it will take time. So we wanted to go back to it. If you can do that for us, sir. Thank you, sir.
Which one now?
Solution to the solution. What we just saw, sir.
What do you want me to do with it? I should do it where?
No, they said the entire solution should be sent to the what's it called, the platform, so that everybody can see it.
Go and buy material.
We have the material.
Sorry, is it inside the material? The solution is only in the material.
The solution is in the material now.
Okay.
The solution
But
is
updating is the issue, sir. Updating is the issue, sir. Because I have the material, I bought the material, but it's not. They don't update on time, so that for us to, and if something like this now we're supposed to after the class, we should go to it, and so that we can.
Don't worry, I've
updated
this now. It will be updated there too.
Okay, sir. Thank you, sir. Then, sir, I would like to call you after the class, sir.
It will. Hope it's contract.
It might not be today, it might not be now immediately because I know that you are tired. So maybe later I will just call you. So I have one or two things to discuss with you.
Okay. So let's focus on today's class now. Before we go, let's discuss quickly. Sir. Let's discuss quickly on a group account. And by next Saturday, I want us to do ratio. Like I explained earlier, the group account is just an extension of combination of two or more accounts. That's what we call consolidated financial position.
Sorry, sir. Quick one, sir. I'm thinking that okay, this the financial report we just prepared now. Will they ask us if we are going to use IFRS 18 in exam, or we must use the IFRS 18 to prepare the POL?
Actually, we don't know where ICANN might be testing, but I told you that I'm going to go to the conference, and I think it will give us an overview of where your exams might likely be coming out from. And then there was no mentioning of IFRS 18 in all of the conference material, the conference, what is it called now? Facilitation. So don't bother yourself much. And in case they ask you to, we did it before now. Just know where to put the operating segment, the investing segment, and then the financing segment.
And financing, yes. You know what I'm asking now is that because of, sir, what I'm asking is because it's part of our syllabus, and in exam now that they may not even ask us to using the IFRS 18 or whatever. But I'm not thinking that since it's a part of our syllabus and we're giving this published account to prepare, I'm thinking that are we going to use that IFRS 18 method to prepare it, or we should use the
they will tell you exactly. They will tell you which one to use. Whether it's IS1 or IFRS 18, it will be well spelled out. It will be well detailed. And in case they are silent, please do IS1 and tell them because IFRS 18 is not yet in use. I use IS1. Yeah, it's as simple as that.
Okay. Thank you.
Yes, sir. I got it.
You're okay.
Yes, sir. But please, I wanted you to. I don't know if you have time to explain the additional information on that Adam question.
Which one?
Maybe you. That question on Adam PLC. I think is in the additional information is too much and it's confusing.
Adama PLC.
Yes, it's on May 2023.
That's group account now.
Is
Is it not group account? Is it a publish? Is it a single entity publisher account?
Yes, it's published account.
Okay, I will check it. I will check it. We may likely use it. We may solve it during our intensive class, yeah. For those that are paid, you can join. And if you have not paid, please go and pay. How much is it now? Intensive class, just for you to be, so all of you go and pay. So we see there and we will solve that dama there in that intensive class.
That, sir, me have already paid. I just want to ask, sir, are we going to treat the standard there, all the standard as well?
Not
or only the working?
Not all now. We are just going to do an overview of all the some of the standards that are key.
Yeah, that's what I mean. Okay. Thank you, sir.
All right, man. All right, Inabas, you are still raising your hand. Okay, put down the hand now. So quickly, let's go to the group account. What is group account? Group account is a consolidated financial statement. And at your level, you have to look at consolidation of a parent, a subsidiary, and an associate. A parent, a subsidiary, and the associate. Now, when we talk about a parent company is any company that have more than 50% stake in another entity. You have more than 50% stake in another entity, or you have some significant control, you understand, in another entity. So if you have more than 50% stake in another entity, that entity that you have more than 50% stake in is known as the subsidiary. Is that taken? Now, if you have less than 50% stake in an entity, but up to 25%, that is 25% to 49%, we assume that to be what we call associate and associate. So that company or that entity is an associate to you. And then if you now have what we call a 50-50, meaning you have 50%, another company have a 50%, it means that you are into what we call a joint venture. So let me take it again. A parent is one that has stake in another entity. If you have more than 50% stake, that is 51%, or let's say 50-point-something% above, that entity that you have more than that 50% in is known as the subsidiary. Then the one that you have less than 49%, between 25% and 49%, is known as your associate. Whereas the one that you have a 50-50% stake in is known as a joint venture. So it is expected that so that you will not be deceiving member of the public, that you have what we call an account open to members of the public so they can see what transpires between you and your other investments. You understand me now? So that's why we have what we call a consolidation of a financial statement. So it is that you consolidate all your financial statement. That is, you bring all the financial statement of all of these investment into one place. You understand me now? And that's what we call consolidation. So the standard that treated this is we have an IFRS 10. Very, very important that you know that. We used to have what we call IAS 27 before. Now we have what we call IFRS 10. It handles it explicitly. Then we have what we call IFRS 3, business combination. It also speaks more on how to do goodwill and the likes. Do you understand me now? So it's very, very simple a process. The major statement that you will be consolidating are the following. Number one, you are going to consolidate that. When we say consolidation, you are merging. You are going to consolidate what we call the zone of financial position. Very, very important. You are going to consolidate the statement of profit or loss. Very, very important. And then statement of cash flow. We don't consolidate usually you don't consolidate statement of changes in equity. And the reason is you cannot consolidate equity because definitely in your statement of financial position, there will have been some adjustment to the equity because you don't have total control also on the other entities' equity. You understand me now? So you can only recognize certain portion of the equity that you have control over, and that's why usually you don't consolidate statement of changes in equity. So we'll begin at looking at the statement of financial position consolidation, statement of profit or loss consolidation, and the statement of cash flow consolidation. It's very, very simple. And then quickly, let's begin with that of statement of financial position consolidation. It's very, very simple. Now I will give you a gimmicks, what to use. What to use. Very, very important that you should know exactly what to use. So we have statement of financial position consolidation. There are two major what will I call it now? Two major formats that I will give you. But okay, let's go to statement of financial position, Sha. Then when we get there, I will tell you. Now, under your statement of financial position, there are two key things that you are going to do for you to pass. There are two steps that you need to know for you to pass. The first step is what I call open the skeleton. Open what? The skeleton. This is the first step. Very, very important. The second step is what I call do the 7 workings. Do the 7 workings. Do what? Do the 7 workings. You see, these two things, very, very important. The first one, I say open what? The skeleton. Always open the skeleton. And I'm telling you, as a matter of fact, that in your exam, if you're able to open only the skeleton and you're unable to do any other thing, you might likely have, if the mark is 10 mark, you may have what I call 2 marks from the 10 marks. Only if you open the skeleton. I'm talking about a financial position now, consolidation. How do you open the skeleton? Very, very simple. They give you the question, they say, Adeola PLC, that you should do. You should prepare a consolidation account for Adeola PLC. Just go ahead and say consolidated account. That is, you write the headings. That's how to this is how to open. Okay, now let's do it this way so that most of us will understand it. Under open the skeleton, what are you to do? Number one thing to do is you write the headings. That's number one thing. Write the headings. Very, very important. Number two, put down the rounding off figure. Put down the rounding off figure. Number three, put the currency. Put the currency. Number four, sorry, please. Insert the items. Insert the items. So what do I mean by this? If they say Adeola PLC, prepare consolidation account for Adeola PLC, the first thing that you will do is you write down what I call what? The headings. This is very, very important. Write down the headings. Consolidation. Sorry, Adeola PLC consolidated statement of financial position for the year ended 31st December 2025. There, that's the heading. I say you put down the rounding off figure. If the rounding off figure is in millions, put it there in millions. Then the next one I say you should put what? The current year, right? Sorry, current year. And then you then go ahead. Once you have done all of this, very, very important. We have notes here. Then the first thing that will come is a PPE, right? Put it PPE. You understand? You may not understand now, but PPE, under the PPE now, please listen, very, very important. Under your PPE, they are going to give you parent PPE. They are going to also give you a subsidiary PPE. Without any adjustment first, you see that PPE of the parent and that of the subsidiary, add them together. So the next thing you will do is open bracket, put it, if for parent is 3, write 3. If it's for subsidiary, if it's 2, put 2, leave it. Go to the next one. If the next one is investment property, write it investment property. Open the bracket. For parent, if it's 1, you write it plus 3. Leave it like that. Go to the next one. Now, maybe current asset is the next one now. And then you have a receivable. Receivable. Put it there. Open the bracket. If parent is 1, write it plus 2. 3 rather. Leave it. Go to the next one. This is how to open all the skeleton. You understand me now? Under the assets. So all of the assets, usually, the one that will always have adjustment is PPE. And that will have to do with either there is an addition or there is a disposal. But for all other ones, likely, I have, I think, if I put it on a scale of 1 to 10, I will tell you that 7 over 10, you may not need to do adjustment on other items. You understand me now? So that's why I said, you open the skeleton is very, very simple this way. So even if this is the only thing that you know, and you put it down that way, I'm telling you that if the mark is 10, you are going to get 3. You understand me now? So that's how to open the skeleton. Now, number 2 step, I said, do the following 7 workings. Do the following 7 workings. Very, very important. Do the following 7 workings. Workings 1. Workings 1 is you determination of the
net asset.
No, determination of the date of wait, just hold on, just listen, please. Determination of the date. Determination of the year. Sorry, not the date now. The years of consolidation.
Okay.
Yes. Very, very important. The years of consolidation is very, very important. What do I mean? They will tell you that Adeola PLC acquire James PLC in the year 2004. I mean, in the year, let's say 2001. Let me use it that way. E.g., Adeola acquire. Please follow me. I'm begging you. James in on 1st January 2021. Is that also? They're not telling you that prepare consolidated account, that you have to prepare consolidated account on 31st December 2024. If I ask you now, how many years is this one? Some people will say it's 4 years. Some people will say it's 3 years. How many years is this? Oh yeah, let's start. How many years is this? Answer me now.
3 years.
Huh? How many
4
years,
years.
please?
4
4
years.
years.
4 years.
4 years. 4 years.
Let's
4
determine
years.
2021 to 2024.
Let's determine it. First thing that you are going to write is date of acquisition. So you write it down. It's 1st January 2021. This is how to, don't do as if you know it. Oh, please. This thing have made so many people to fail in exam. That's why I'm doing it one after the other. Date of acquisition. What is the date of consolidation? Date of consolidation. Write it this way. Nobody will beat you. It's your book. Date of consolidation 31/12.
December
24. Is that not so?
24.
So
Yes.
what you do is 31. What we do is 112 to 11 to 112/21 is what? 1 year. Is that not so?
31/12/21.
Sorry, 31/12. Sorry. So you can see, so 31/12, that's 1 year. So 31/12/2022 is what? 2 years. 31/12/2023 is what? 3 years. 31/12/2024 is 4 years.
4 years.
So you can see that your date of consolidation or the years of consolidation is what? Is 4 years. This thing is very, very important. That's your workings one. Do you know how I did it now? I'm sure you do.
Yes.
Okay. Workings 2, determination of the group structure. Determination of the group structure. It's like most of you are tired already, right?
No, sir.
No, no at all.
Okay. Determination of the group structure. That's the second workings that you are going to do. How do you do it? First of all, you write P, which represents the parent. Then you write S, that represents the subsidiary. And then you now draw an arrow. I don't know how we're going to draw arrow now. Draw an arrow from P to S. Very, very important. Very, very important. You draw the arrow. It's very, very important that you do this. Now, look at it this way. How do you determine the group structure? You look at it, they say, Adiola acquired James on 1st January 2021. They will tell you the amount, or they will tell you the percentage. And if they did not tell you, you have to determine it. Now, acquisition can be either, okay, in our next class, we're going to look at that actually. So, sorry, please. They will tell you that Adiola, for instance, acquired James on 1st of January 2021, and the acquisition is 80%. You understand me now? I wanted to discuss on the purchase consideration, the consideration that we can have, but let's not do it today. We'll do it in the next class because we have about 4 different kind of consideration. When I say consideration, they are the method of payment when you are acquiring. You understand me now? Or let me quickly mention it in passing. You can buy in cash. You can buy in cash. At least you pay cash. You can buy by exchanging. That's what we call a share exchange of shares. You can buy like that. And you can. The third one is you can buy on credit. Let me just use that word. You can buy on credit. You buy the
consideration.
Yeah, that's what I know where I'm going to. But it's better I use that word credit first because that's what we call deferred consideration. You understand me now? That's what we call deferred consideration. So you can buy in cash, share exchange, or deferred consideration. You understand me now? These are the 3 main types of consideration. Under the deferred consideration, there are 2 types, but let's not go deep into that. But I know I've said this now today. I won't go back to it in the next class, so please take note of that. So now, how do you determine the group structure? When they say that Adiola acquired James, acquire 80% of equity in James PSC. Adiola acquire 80% of equity in James PLC. Adiola acquire, where is our question? Acquire 80% of equity in James PLC. 80%. So how do you determine the group structure? Very, very simple. Just come here and put it bracket 80%. Always write it to that percent is very important. Go to this is parent now. Let's use their initials. A. Adiola is the one that acquire James J. So you put it J. Bracket, you put it there 20%. You understand? You put it 20%. This 20% is what we refer to as what we call non-controlling interest. In other words, the parent do not have control over this 20%. You understand me now? So it's important that you let the members of the public know that the James that Adiola had investment is 20% inside of that James. Adiola do not have control over it. That is the essence of the group structure. Is that taken? I know you do. Any question?
Yes, sir.
Workings 3. Workings 3 now will not be determination of the fair value of net asset, fair value. Now we are beginning to do more work. Fair value of net assets, of the subsidiary. Now there's what I call at. Now you open bracket here. You have what we call at date of acquisition, date of consolidation, and if you like, you can put it date post consolidation. I used to use what I call post consolidation sharing or cutting or adjustment. Just put it as a post consolidation date. Now, the date of acquisition, when we do example, we will be knowing all of this, but just know this, that we want to determine the fair value of the net asset of the subsidiary at the date of acquisition, the date of consolidation. Now, the differences between these dates is what both the are going to share. Very, very important. That is workings 3. Then from here we proceed to workings 4. And our workings 4 is determination. Workings 4. Determination of goodwill. Very, very important. Determination of goodwill. Please just follow it the way I'm following. I'm telling you now. That is your workings 4. And this is where you separate your purchase consideration from the net asset, the fair value of the net asset of the subsidiary at the date of acquisition or consolidation, as it were. You understand me now? Determination of goodwill. That is the 4th workings. And then workings 5 is determination of group retained earnings. Very, very important. The group retained earnings, you have to determine it. Please take note. And then your working 6 is determination of non-controlling interests. Do you understand it now? Are we still together? Instead of using this group retained earning, please use group reserve instead of group reserve. Don't use retained earning, use group reserve. And then working 6. Then working 7 is determination of other adjustment. You see, you cannot do all of this and not be very fast and not deal with your question appropriately. So let me not bore you, but please just take note of the two things that I've just said. Very, very important. So let me not break your head with all of this. So that the next class, we're just going to look at questions and we deal with all of this. Remember, we still have to look at consolidation of financial statement, consolidation of profit or loss, and consolidation of cash flow. Chikodi, you are raising your hand.
Okay, yes, sir. Please, I have more questions to ask. In the example, are you allowed to use this deal and they just the abbreviation like that? Or I must write it in full?
See, if you want me to kneel down now, we kneel down, beg you. Don't ever abbreviate in the exam, please. For no reason should you abbreviate. The reason is, wait. The reason is this. You may write, for instance, I write WK here now. You now it means walking, but to the marker will tell you, this is week 1, week 4. Do you understand now?
Yes, sir.
The second question.
Okay. Sometimes I usually get confused about date of consolidation and date of reporting. Like they are the same thing. Are they the same thing?
Come again.
This date of report, we have something to do with date of consolidation or date of reporting, and also have date of acquisition.
Olafe, can you hear him? And can you hear her?
No, I can't hear her. I think our network is having issue. Your voice is breaking. I don't know if you can move away from there. Maybe where you are, the network is poor, so we're barely hearing what you are saying.
I did the same thing.
Come again. Nabasi, you said?
She said the date of consolidation and date of reporting, are they the same thing?
Yes, they are the same thing. Reporting date and consolidation date is the same thing.
Okay.
Chico, is it clear now? Yes, it's the same thing. The day that you are reporting is the same day you are consolidating.
Okay, the last question, sir. When you are not giving the percentage of acquisition by the parent company, what's the formula to use to determine the percentage acquired? Like, is there a specific method to identify that?
Yes, you can. Definitely, you will use the consideration, the mode of payment, the mode of acquisition. You can use it. For instance, you can use the cash, the what is it called now? The if you are to use cash now, for instance, if they say James PSC Adiola acquire James for 500,000 naira. For 500,000 naira, and then they now tell us that the equity of James is let's say 100,000 naira. I'm trying to look at a very fair way of doing this now. The equity
can we
of
do it
James,
in this way, sir?
Go ahead.
Okay, I just want to buttress your point, sir. Maybe in a situation whereby we are not giving the percentage, but in form of cash, maybe they say the net worth of the worth of the subsidiary, say for instance, is 500,000, and the Adiola, and the parent pays 300,000. So you can just factor the percentage. They said you acquire the parent paid 300,000 out of the 500,000. That shows that the 500, that means 300,000 divided by 500,000 times 100. That's the percentage of the parents, where the remaining one is for the NCI.
Thank you so much, Olafe. So that explains it. So you can use that method to actually determine your percentage, as it were. So they will tell you that this is the net asset or the net worth of the subsidiary, and this is the amount that this individual paid and to acquire that a percentage or a worth in that subsidiary. Do you understand now? So that's why I said the consideration that is used can be used to determine the percentage, as it were. And this is also where you determine the goodwill from the acquisition, whether that will be a goodwill that you are going to carry forward or the goodwill that you are going to charge into your financial position, of profit or loss. Adedayo Bigcroft. Okay, go ahead.
Yes, sir. I just want to talk about what you just said, sir. In case they said the parent company acquired, let's say, 100,000 shares in the subsidiary, and
they are going to tell you the total share of that company. You understand? Assuming they say the total share of the company is 120, and then the parent acquire 100, just put 100 over 120 to give you the exact percentage that is being acquired.
Sir.
Hold on, Chiko, the way. Let Adedayo finish.
Okay.
Okay, go ahead, Chiko.
Okay, sir. Please, I've come across some questions where under the non-current assets, we see investment. And I've seen questions where they will exclude the investments. Like, this is confusing me. I don't understand.
Thank you so much. You see, assuming, okay, well, you have asked, I wanted to bring it up in the next slide. There is what we call, don't ever do when you are doing consolidation. Don't ever do it. The first one is this, what you have just mentioned. In your question, you'll be told investment in subsidiary. When you are consolidating that investment, you will adjust for it under equity, and so therefore you are not going to carry it again as part of your asset. Now let me explain it this way. When you are a standalone entity, when you are a single entity, Owolafe, for instance, acquire Adedayo, we agreed. But before the consolidation, they are preparing their accounts separately. Owolafe preparing his account, Adedayo is preparing his account. Now, Owolafe, let's assume Owolafe is the parent and he has investment in Adedayo. Being that Owolafe is preparing a standalone account, he is going to state it in his own, under his own asset, and said investment in Adedayo. Do you understand? Prior to their consolidation. Do you get it now?
Okay.
And when they are now consolidating, that investment in Adedayo, do you understand? That investment will be adjusted for under equity. That's when we are doing that working theory that I said we are going to determine the fair value of the 9,000 of the NCA at date of acquisition, at consolidation, or at reporting, and then post consolidation or post reporting date. You understand me now? So once you have done consolidation, that investment must not appear anywhere in your financial statements again, because you are going to adjust for it under your working theory. Clear? Any other question?
Okay.
Say okay.
When do we now bring it up? Like, when do we now bring it up under non-current assets? Because
No. You are not bringing it again under anywhere. That's what I just said. You are adjusting for it under working theory. You understand now? That investment, you see, sometimes they will not tell you the percentage. You understand? So you can use that investment also. Investment in Adedayo, they write the amount. When they write that amount,
sorry, sir, can I?
Hold on.
Can I? Okay.
When they write that amount there, investment in Adedayo, you will see it. Maybe they write 300. When you now go to the Adedayo,
what you're saying now.
When you now get to the Adedayo, you are going to see almost that same amount there. So that's how it is. Okay, well, I thought you said you wanted to say something.
No, I just want to assist you in the explanation, sir. maybe so that for her to even get it much, based on my understanding. You know that investment in subsidiary is somehow equivalent to what you invested, the amount that you used to acquire that subsidiary. Just like the example I cited earlier, you know, I said out of the 500,000 was that asset, you acquire the 3,000. You know, in your own personal account before the consolidation, what you be having in your account as that investment in subsidiary is that 300,000. Are you getting it now? But because of it has been consolidated, you cannot carry that 300,000 naira again because it is part of what you've used now to acquire, which is that working note 3 that our boss just mentioned now, which is that net book value adjustment. Ahead, which yes, ahead. Okay, which is that net book net asset adjustment that we just did. So that's why under the consolidation, we are not bringing that investment in subsidiary again, because by bringing it in, it's just like double counting by bringing it in again, because it's part of what the money, the purchase consideration that you use to acquire that subsidiary. I think that's my little explanation.
When we begin to do examples, I'm sure you will understand better. So don't. Are we still together, please?
Yes, sir.
So we are going to call it a day here. I'm much exhausted, and I want to believe you are fine now. Any question, please?
Thank you.
So thank you so much for your time again today. I'm sure I've been able to add 1 or 2 knowledge to you and preparing you for your exams. I'm very much hopeful that those of you that have 2% confidence, 2/10 confidence before, your confidence will have risen to 7 now, right? Where's my Chikodi?
Yes, sir.
Your confidence have Ria too, right? Your confidence have increased. Where's my friend Damilola? Please ask me questions on the WhatsApp, and I will attend to you as I can. Thank you so much. I wish you the very best of the weekend.
Thank you, sir. Don't forget my call, sir. I said I'm going to call you later, sir.
Okay, no problem.
Okay,
Sir,
thank you,
please
sir.
help us upload the YouTube video as soon as possible, sir.
It's on the YouTube already now. As we are done with this, I think it should be uploaded there.
Thank you, sir.